Following the decision by voters in the United Kingdom to leave the European Union, the investing world has suddenly been turned on its head. More and more people pulling out their hair, trying to find safe havens, looking for money to find a home. Net, so far, positive for South Africa, but we haven't yet got any decent trade agreements in place with the new independent Republic of Britain, and we certainly will have to renegotiate some of our trade deals with the European Union. In the short term, though, the global uncertainty that Brexit has precipitated has led to something of a currency boon for South Africa, and perhaps a window of opportunity to get our own ducks in a row. This is the MoneyMakers. I'm Bruce Whitfield. Tonight I'm joined by Dr. Hugo Nelson, Chief Executive, Founding Partner at FVC Advisors, and Lorenzo Tencati, who is Managing Director at Bryanston Resources. We'll look at Brexit, we'll look at the implications for South Africa, South African investors, including, of course, the future of commodities and what does constitute a safe haven for investors. My favorite recent tweet was one from the Chief Executive of the Post Office, one Mark Barnes, who warned against the flow of capital around the world, saying that hot money is looking for sex, not for a long-term relationship. And I guess that shows the vulnerability. We look at the volatility in the currency, Hugo. I mean, Brexit precipitated a new phase of global uncertainty. Yes. Good for us now, but as Mark Barnes suggests, it can turn really quickly.
Yeah, that's true. I mean, to some extent, I suppose that around the world we were looking to get off this period of stimulation and sort of liquidity creation, which has gone on for about 8 years, money printing. And all the uncertainty that Brexit injected into the system caused everybody to just run back to the positions they were in before, and we've seen that in global bond markets, etc. I
mean, Britain has cut interest rates from 0.5% to 1/4%. Yes. After 8 years of preparing markets to raise interest rates, Mark Carney had no choice but to cut rates to 1/4%. That's a form of stimulus. The Japanese keep trying to stimulate. The Europeans keep trying to stimulate. Sitting on the sidelines is the United States, which ostensibly has got jobs numbers improving, average hourly wages improving. America seems okay in a world of uncertainty.
It does, but to some extent, because of all this global connectedness, we've even seen U.S. bonds, yields contract in the wake of this. So I think to some extent, Brexit has sort of perpetuated and sort of lengthened a trend that we've been seeing for a while now, which is this kind of desperate search for yield.
Yeah, absolutely. It's the search for yield which is counting in emerging markets' favour, and we've seen a combination of issues, a bit of currency strength coming through post-Brexit, and then a little bit of democracy in action in South Africa, taking the world by surprise, and the currency ending up at 10-month best levels recently.
No, I think it's good for emerging markets in general. I mean, and South Africa being very well poised to get a benefit out of this, because it's amongst the emerging markets, is one of the ones where the stock exchange is most liquid and well established. So I think whatever pushes investors into the safe havens on the one end, so gold and US bond typically, it also pushes capitals into, because investors also look for yield, it pushes capital out of the trouble zone, Europe, into emerging markets.
But again, it makes us then vulnerable to the next trend, the next flow, the next flick of a light switch. As Mark Barnes, the ex-banker, so he understands this stuff, and now in the Post Office, understands only too well.
I think it does, but if we really take a fundamental view, I mean, up until now, at least, what really has Brexit meant? I mean,
well, nothing yet, because they're yet to invoke Article 50. They're yet to take the first step to leave. Right now, they've got Boris Johnson in charge of exiting, and he's now stuck. He's like the dog that caught the bus. He's not quite sure what to do with it.
True. I mean, look, if you think about the fundamentals, which I think is the only safe bet we can make, so far, I think investors have to not panic. That's the main thing.
We saw the panic happen. The days after the Brexit vote, stock markets in the UK fell, the currency retreated dramatically. We haven't seen a recovery in the pound. It's still 130 or thereabouts to the US dollar. And so there has been the panic, and now we wait for the certainty to either settle things or to see an improvement in the UK.
I mean, arguably that initial reaction was driven by how one-sided expectations were before the vote. So I think if there'd been if the probabilities were a fair reflection of where we ended up, one wouldn't have seen that big reaction. But the whole market, together with all the bookies and everybody, was were basically saying remain.
They took a London view, not a British view.
Exactly. So I think that big response that we saw was more because of the pre-existing opinion, kind of expectation.
Yeah, and there was that shock reaction.
Yes.
Much now depends on how the exit is executed, because Theresa May, British Prime Minister, has said Brexit means Brexit. They'll try and negotiate the cushiest deal they can, but the European Union's stuck in a damned if they do and damned if they don't, because if Britain gets off too comfortably, then what stops the rest from saying, actually, I'd like a little deal where I don't have to fund the Portuguese, the Spanish, the Italians and the Greeks in future. Thank you very much.
But I think if you think about it, I mean, the best outcome for both parties is one where neither loses face, but nothing happens. So isn't that what's going to make the headlines on the newspaper on the one hand, that nobody loses face, but on the other hand, everything stays the same? And if that was the case, then again, I think the impact of Brexit would be at best mild.
But then you've got a British electorate that says, hold on a second, we voted to exit. And a political party in power right now, as the Conservatives are, then run the risk of a poll defeat the next time they go to the polls. That's not a solution that they're prepared to countenance.
True.
I mean, the right decision may not be the right economic decision, may not be the right political decision.
Well, I think that so I agree with that view. I think that the best outcome is sort of
as little as possible.
Yeah. And I'm not a political analyst, but I can't see how the Conservatives will lose an election, because the opposition's in disarray.
Not just yet.
My sense is that it is interesting that they've got a Prime Minister who actually did campaign to remain, and she's given, as you say, the bone to
Boris Johnson.
To Boris. I think that it is a difficult situation, because on the one hand, as I think you were alluding to, you don't want the other similarly disgruntled states to start feeling like they can go the same route. On the other hand, it's probably not good for Britain or the EU to actually change anything.
No.
So arguably the best scenario is the sort of Norwegian outcome where they pay for market access, but with the fly in the ointment, of course, being the free movement of peoples, which is the difficult issue.
And the voters of Britain have said, we don't like this free movement of people. We feel marginalised in our own country, and that's where the politics of it comes in.
Yeah.
From an investor perspective, you are a South African. Your name is Sizwe, your name is Joe. Give yourself a name. You have got an investment portfolio. You've got a house. You've got a car. You've got school fees. And people say, you keep hearing via platforms such as this one, reading in the newspaper, that now is the time to take advantage of a strong rand and offshore your investments. You've got 10,000 rand or 100,000 rand. What do you do in this global environment as Sizwe of Santon with a good job and a little bit of extra cash?
Look, I think that you want to be diversified, however you achieve that. If you're a South African citizen and you work here and all your kind of core assets are here, you're very exposed to this market and related markets, whatever the related drivers are. Potentially emerging markets, potentially the commodity cycle. And so you want to diversify away from that. But having said that, I think that you also have to be quite aware of or sensitive to valuations. So on the one hand, sure, maybe we've seen tremendous volatility in the rand, and maybe it does present an externalization opportunity now. But you have to think quite carefully about if you are going to, let's say, go into dollars or euros or wherever you're going to go, and you're going to deploy that money or your savings. You want to do it at attractive rates of return in those destination markets.
There are so many different issues at play here. One is the currency play, which everybody understands.
Yes.
The next step is more complicated, and it's choosing an asset manager, an asset class, an index, whatever it might be that you prefer outside of your area of expertise, outside of your home country. That becomes quite complicated because typically people are a lot more comfortable taking money out at 25 to the pound than they are at 17.50, because 17.50 implies further strengthening.
Sure,
and a lot of South Africans get caught short at a time like this. Then, I mean, you've seen the cycles.
It depends on the rear view. You're right. And what does make it difficult is that globally, particularly so-called safe assets, be it government bonds or bond-like equities or these sorts of things, are incredibly expensive.
Yeah.
And so it reminds me of an expression which was bandied about. I think I can't remember whether it was before the 2000 crisis or the 2007 to 9 process. Somebody said the party's not over, but dance close to the door.
Yeah.
So it sort of feels a little bit like that with some of these assets. And if anything, you actually want to have a de-risked portfolio. You probably want, in general, when you're looking at your overall allocation, you probably want less exposure to risk assets, which is actually the inverse of what generally people are tempted to do when you've got reduced returns. Because really the variability of returns has sort of increased at these elevated levels in the developed markets.
But that's the trouble. So as a South African then, what do we do?
I would take, although I agree obviously with the diversification and everything, and I wouldn't risk the farm, but I would take a little bit more of a contrarian view when it comes to the little bit of money that you can put and take a higher risk in exchange for hopefully a higher return. And in that sense, if you think about the classic Warren Buffett quote, or be greedy when the market is fearful and be fearful when the market is greedy, then isn't this the time to start looking at good UK companies or even real estate assets?
At some point, you've got to want to buy Intu and Capco and the countless other opportunities that are there. Banking assets are incredibly cheap in the United Kingdom right now.
Absolutely.
With just reason, but how much more broken can it get? And that's the call you've got to make.
Absolutely, absolutely. And I would look especially at those companies where the market might have overreacted because they are based in the UK or listed in the UK, but for which the costs might be also partially pound exposed, but the revenue might be global. So unless the world falls apart, that the fundamentals of that business will not change, and therefore the valuation will likely be. I mean, the market is a moody, depressed, bipolar creature, right?
And you want us to put money into it? Excellent idea.
You want to play against it.
No, yes, exactly right. They're both YPO members, Dr. Hugo Nelson, Chief Executive and Founding Partner at FVC Advisors, and Lorenzo Tencati, who is Managing Director at Bryanston Resources. Fascinating insights into an uncertain world. Where do you put your money? Where do you take your chances? Is it red or black, or is it on the long-term future of markets? And at what point do you decide to externalize some of your South African money? Those are questions only you and your financial advisor can answer, of course, but think about it carefully. Thank you so much for watching The Moneymakers, and thank you to my guests this evening. Good night.